Hey everyone, welcome to chapter 12 of Small Business Management. Today is actually Sunday, March 22nd, so you probably won't be seeing this for another week, but I'm trying to get a head start on some of these chapters because I've got, between this class and the others that I teach, I've got a lot of videos to make. So anyway, we're going to be talking about sources of financing of a small business, and you're going to have to shut up or I'm going to have to put you in the other room. Shh. Excuse Winston. He's a little talkative right now. I'm going to have to put him in the other room. Okay, Winston's in the other room and hopefully won't be making us so much chatter. Anyway, when you're starting a new business, the very first thing you really need to think about is, where am I going to get the money? How much is it going to cost and where am I going to get the money? And that's really what we're going to be talking about today as we move forward in chapter 12. How much capital do we need to start this business? Not only to get the business open, to be able to open the doors, but also enough money to keep the business running, at least for the first 6 months. A lot of businesses fail because they have enough money to get the business up and running, but they don't put in they don't really realize how much time it's going to take to get this business running so that it supports itself. So a lot of experts will say you need 6 months of capital in order to be out there long enough for customers to know about you, hear about you, and to come and actually try you out as a business. So this money is important. The amount is important to know. Now, some entrepreneurs don't have to worry so much about this because a lot of times, take my example for interest. For example, um, my my business started, but my wife was still working, so we still had a little bit of income, fixed income coming in every month. So it wasn't as imperative for me. But for others who might have no money coming in, it's very important to find out where you're going to get this money to start this business. So, where do we get the money? Is it through equity or debt? So, we're going to talk about the differences between equity and debt and some disadvantages and advantages of each way. I think I've mentioned this several times, but most startups are actually funded out of the owner's pocket, just like I did it. In other words, there was no loans. There were no loans. There were no investments from outside investors. It all came from the owner. But there's other ways as well. So let's look into those. We might dig into our personal savings, which is what I did. I borrowed from my equity line of credit on my home. Luckily, we owned our home outright, so I had a fairly large equity line of credit against that home. Some some entrepreneurs may look to family and friends for either some short-term loans or um, willing to actually let them be part owners or silent partners. Some people might even use credit cards to help fund their startup. In other words, maybe buying inventory or buying supplies, equipment on credit. It's a sort of a risky way to do it, but a lot of people have some credit lines through their credit cards that they can do that. Your personal savings would be equity financing because any money that you put into the business as an owner, that's equity financing. We'll find out later, family and friends can be either, but credit cards would be simply debt. It would not be equity financing. It would be totally debt. And we'll take a look at that in a minute. So, what are the differences between debt and equity financing? So, debt financing is the money that you're going to have to pay back. Okay? You're going to have to pay it back in some type of payment. So, if you get a loan from a bank, that's debt financing. You might get a loan from a family or a member of your family or a friend, and you may arrange it so that you pay them back in payments. And nearly always, even with family and friends, there's some type of interest added. Otherwise, what is the incentive for that person to let you to lend you money? Then there's equity financing, and this is the money that first of all, this is money that you invest in the business as an owner. That's equity financing, and you can let outside investors in and let them be part owners. But even with that, there's going to be less profits to share uh, because you're going to have to share those profits with everyone who's an owner, and you're going to probably have to pay dividends. Again, there has to be some type of incentive for them. So that's the primary differences between debt and equity financing. Um, Obviously, you have multiple owners if you have lead investors, if you bring in an equity investors. Um, and then the bank is your primary debt lender. So here shows the trade-offs between the two. If we take a look at the first or the top example, where we have high equity and low debt financing. So here we have, obviously the owner has put in money, and possibly they've brought in other investors who are going to share in the ownership. So when that happens, what happens to voting control? Well, the original owner or the entrepreneur is going to have to share the control with the other equity investors. That's just a given. Now, the financial risk is lower because there's not a monthly payment that you have to be paying back to these owners. Okay, so that is going to actually lower the financial risk. But the potential profitability is lower because you're sharing the profit with others. If you take a look at the bottom example where you have high debt and low equity financing, here the original owner or the entrepreneur, they maintain the voting control. They maintain control of the company because those who are loaning money, they do not have any type of influence on the decisions that are made day to day or share in the voting control of the organization. There is a higher financial risk, though, because these payments have to be made month to month, and you have to make them no matter what. The potential for profitability is higher because you do not have to share the profits with anyone. The profits all go to the original owner or the entrepreneur. It gives you some trade-offs. That shows you some primary trade-offs between debt and equity financing. So what are some of the characteristics and sources of financing? What are some of the factors that determine whether or not we we finance through equity or we finance through debt? Well, first of all, might be the firm's economic potential. Um, if you have a small business that you're starting and no one knows really how it's going to go, it's 50-50 whether or not you'll make it or not, the economic potential maybe is fairly small, you're probably going to have a hard time getting debt or equity financing. But you'd probably, if it's brand new out of the gate and it's never been a business before, you're probably more than likely to get equity financing than you are debt financing. Banks don't like to lend money to brand new businesses. They like to see some type of history before they actually lend the money to the entrepreneur. The company size and maturity. If the company is a fairly large or let's say a medium-sized business even, and it's been around a while, then you're likely to be able to get debt or equity financing. Say if you want to expand. The nature of the firm's assets. If the company has a lot of assets, it's going to be quite easy to get some type of loan through a bank. And it's probably going to be, if you want to go that route, it would probably be easy as well to get equity financing. And then the owner's preferences. Maybe the owner doesn't want to give up any control, so they would be more than likely to go towards debt equity versus debt financing, uh, rather than equity financing. Now, let's use an example today. Let's say that you have a business that can convert, or let's just say you're a brand new business out of the chute, and you are going to make mask, medical mask. We know those things are in high demand right now. You would probably be very likely to get a loan from a bank if you could show that you could produce X amount of mask over the next several weeks. And you could do it quite quickly and quite efficiently. That has a lot of economic potential. Therefore, you could probably get easily get some debt financing. You could also easily get some equity financing. The economic potential would be very high in that case. Let's say right now, if you wanted to open up a restaurant with the conditions the way they are with the coronavirus today, then you're probably going to have a hard time getting either. Your economic potential is low, and so it's probably be hard to find equity or debt financing to help you with your business. So just some things to think about, some factors to determine which way you go, whether it's debt financing or equity financing. So when we take a look at equity and debt, here are several ways in which we are sources of financing. Personal savings is always equity financing. Friends and family can be either. You could give them equity in the business, or you could pay them back in the form of a loan. That's debt. Same thing with individual investors. They can be equity financiers or they can be debt financiers. Commercial banks are always debt. Business suppliers who may give you trade credit, which we'll talk about in a minute, are always debt. Asset-based lenders, always debt. Government-sponsored programs, microloans, always debt. Venture capital firms can be either. They can be equity or debt financing. Community-based institutions that specialize in loaning money to small startups, debt financing, always. We'll talk about large corporations and how and why they might help you with financing a new business. But again, they can be equity or debt. And then public sale of stock. If you actually sell some type of stock, that's always equity financing because stock is part ownership in the company. So that would be all equity. But this graphic here gives you a really good idea of what's equity financing and what debt is debt financing. We talked about this already, but the trade-offs between debt and equity are the financial risk, potential profitability, and voting control. And I think I've already discussed that at length. Bank financing comes in a couple forms. You can get a line of credit or a revolving credit agreement. Usually these are very short-term loans, maybe 60, 90-day loans. A lot of small businesses will get these to meet payroll during slow times. Term loans, almost like a car loan, 5 to 10-year maturities. And then you have mortgages, where you actually take out a mortgage on maybe the real estate that you own. But these are types of bank financing that is available. When you're trying to get a loan, and this goes not only in the business world, but even for personal loans, there is something called the 5 C's, the foundation for getting a loan. And the 5 C's are this. First of all, they start with your character, the borrower's character. They're going to do a check on you when you apply for a loan. And, if prior arrests come up or some type of bankruptcy comes up from the past, this is going to have an effect on whether or not you get the loan. Capacity to repay the loan. Do you have assets? Do you have cash flow? The owner's capital invested in the business. This would be basically how much money has the owner put into this business. We want to know, is the owner invested in this business? If you go to a bank for a loan and they ask, well, how much have you invested of your own capital, and you say nothing, they're going to feel that this might be a risk because you don't have the confidence in the business to actually invest your own money. Collateral to secure the loan. Maybe you've got money in the bank or personal savings. Maybe you've got several large pieces of equipment. And then industry and economic conditions. What does it look like right now? Obviously, anything with this time that we're going through with the coronavirus, the economic conditions for a restaurant or other types of commercial businesses might not look so good in the short term. But if you were in the medical field or in the medical industry, it may be very good. So those 5 C's are character, capacity, capital, collateral, and conditions. And that's what bankers and people who are loaning money are really looking for, those 5 C's. We talked about vendors or suppliers loaning you money, and here's how they do it. And I may have talked about this before, but once you've applied to be a customer of a supplier, they most of the time will give you some type of short duration financing, and it's usually only 30 days. But what this means is, let's say you open up a dress shop and you order from a New York supplier in the fashion district, you order 300 dresses. Well, you order on March or April 1st, let's say, and on April 10th, those dresses come in. And let's say they were shipped on April 8th. Well, from April 8th, when they shipped, to 30 days out, you basically have that time to pay the bill. So you could actually have those dresses in your place of business and selling them, and have yet paid for the dresses to the supplier. That's financing. I mean, they are basically giving you short-term financing that way. And sometimes they will give you a discount. And if you take an accounting, you've probably seen this, where it's like 2/10 net 30, basically meaning we'll give you a 2% discount if you pay within 10 days, but everything's due by 30 days. 210 net 30, it could be 25 net 30. But this is a form of financing, and it's called trade credit. And most suppliers will give it to you, especially to established customers. They might not give it to you up front. I remember when I opened my business, one of my major suppliers was called Graham Field. And Graham Field was out of Atlanta. They sold a lot of wholesale medical equipment. What I did is I applied as a customer, and I applied for basically to get trade credit. My first order, I had to pay up front. I paid on a credit card, and that order was like $6,000 or $7,000 worth of equipment. But after that was paid, and after that first order, they started extending me 30-day credit, short-term trade credit. And it really helped out because a lot of times I could get their equipment, sell most of it, and then make the money to pay the bill and still making profit from it. So it's very helpful. Equipment and loan leases. Now, the only thing I want to bring up here is a lot of people will tend to buy equipment. And if it's something small like a small printer or a computer, obviously you're probably going to purchase it. But if you basically have to purchase large equipment, say a tractor or a truck, you may be better off to lease that equipment, because if you lease the equipment, that frees up cash for other reasons. Okay, it leaves your credit line open for more loans or more credit. Okay, and it also provides you a little bit of a wall against that particular item going out of date. Let's say you have a piece of equipment that has to be upgraded every 3 years, almost like a computer. Well, maybe you only lease it for 3 years, and then every 3 years you just lease a new one. That way you're always getting the most up-to-date equipment. Also, because you leased it monthly, you pay much smaller payments than you would if you had to pay for it all of it up front. So you free up cash, it leaves your lines of credit open, and you provide a hedge against obsolescence, and that's important. What are some other ways to get some money? Well, real quick, crowdfunding. I think we all know what this is. This is where you have you raise a lot of small investments from a large number of investors through the internet. And sometimes what you have to do is you basically have to give them some sort of small, uh, small gift or maybe a sample of a product. And but it is an easy way to raise some money. One of the examples that I give at this point is I read in the Wall Street Journal there was a fellow, I think he was out of Washington, D.C. He was competing against Under Armour, and he had developed this shirt that would change colors as you worked out. So as your body temperature increased from the workout and your pulse rate increased, your shirt would actually change colors. And he had to have this shirt manufactured overseas. And for a certain amount of investment, he would give everybody through his crowdfunding platform a shirt. So what he was hoping was everyone would pay basically upfront for the shirt through an investment of, let's say, $100. And he would actually send them, their reward for doing that would be a shirt. And that shirt, hopefully, he was betting on would only cost him somewhere in the neighborhood of $12, $15. And he would be able to take the rest of the money and invest it in his business. It gives you sort of an idea of crowdfunding and how it works. There's also loans through the Small Business Administration. There's microloan programs that are around. All these are debt financing where you have to pay back at a very small minimal interest rate. And so there's a lot of things that are out there. You just have to take the time to research and see what's available. There's state and local government assistance. There's also some community-based financial institutions that specialize in lending money to small businesses or startups in the local area. They're trying to encourage economic development. It's almost sort of like the West Virginia business plan competition, where the winners get so much money for their business plans. They don't have to pay it back, but it's sort of like a grant. But they would be sort of classified in this community-based financial institution category. Large corporations might finance companies if they found a supplier that they needed, and they needed in order let's say that Ford Motor Company found a supplier of a certain part for their cars and trucks, and they really liked the part that this company produced. They might actually invest in that company so that that company can expand in order to meet the capacity of Ford, their company. And so large corporations might provide financing to suppliers. Stock sales through initial public offerings, obviously we know what that is, but that's where we go public and basically sell our stock so that we can, and that's equity financing. So that's pretty much this chapter, the sources of financing. What you should do is, read the chapter in the textbook, review the slides once again. Your slides may look a little bit different from the ones that I just reviewed. I modified these slides a little bit, but take a look at the slides. Obviously, you reviewed this video. You may want to go through it again, and then take the chapter quiz, which is in the virtual quiz folder and you will find the quiz for chapter 12. Remember, it's timed. I don't exactly remember how many questions there are, but I've been giving more than enough time to take the quizzes, so you don't have to worry about that. If you have any questions, give me a call, but good luck. I'm sure you'll do fine. And again, please try to get the most out of this as you can. Uh, I want to make sure that you're getting as much out of this course virtually as you would have is if we would have even stayed as a face-to-face class. Okay? If you have any questions, let me know. Make sure you're working on those business plans. Don't forget those. You've got lots of time, but I don't want you to get lazy and put it all together all at once. Those usually don't make good grades. I'll talk to you all soon. Bye.